Parekh of DSP Mutual Fund is here with me on the phone line. Kalpen, good afternoon. Thank you very much for your time. In our newsroom, along with our discussion with friends who are also investors, the main question right now in everybody's mind, oh, he's right there on Skype, is that working from home, of course, what to do with the SIPs which are going on right now. And every incremental SIP is, though buying me more units, but it's in the loss. My overall accumulated SIPs over the last 3 year, 5 year have also turned negative. What should we do about it? So let's talk about this instrument of SIP and what it does, especially in extremely bad phases like this one.
First of all, thanks, Ajaya, and thanks for keeping the show on in spite of all of us working from home. And, as much as in the last many years that we have discussed about temperament and behavior being a very important ingredient for long-term wealth creation, to follow those principles in times like today is a real test. And to keep cool in terms of, looking at our portfolios every day and seeing that the value is very different than what we would have expected is where the real challenge is. So very easy for me to say that stay invested, don't worry, because these are, the standard principles that we have always learned and benefited from over the last 20 years in ordinary market situations. These are not ordinary market situations. These are extraordinary situations. You asked a very pertinent question that what do you do about your SIPs? And I think, before I came on the call, I was just doing some maths. It's always good to, talk with data and not just emotion. We encountered a very similar environment in 2008 and 9. While the speed of that market correction was different, and the speed of this market correction is different. But, in that cycle, equities temporarily lost 60% of value from the peak. This time around, markets have lost around 40% from the peak. And the SIP cycle in India has truly started only in the last 4 or 5 years. Only since last 5 years, 2015 and 16 is when SIPs have started. So the 5-year SIP returns today would be flat to negative. It was exactly the same case in 2009 bottom, where, of course, at that point in time, SIP was not such a large wave as we have seen today. So very few investors were invested through SIPs. But if you just compare it then, the SIP returns in 2009 bottom for the last 3 years or 4 years was almost minus 8 to 10% negative for the accumulated units. But as you rightly said, investors who had a longer time horizon, and that is what make investors really do 5-year, 10-year, 20-year SIPs. Those SIPs eventually turn around when markets turn around. So if we have a belief, and I do have that belief, that at some point in time, normalcy will come back. It might take time. I can't give you the timeline, but some point in time when normalcy comes back, the accumulated units itself will go up and normalize the losses that we are seeing right now. So as an investor, we feel very happy when our NAVs are rising and we are acquiring lesser number of units. But in cycles like this, SIPs are actually designed for these moments. It would be highly unfortunate if the time for SIP to work, which is now when prices are lower and acquiring more units for us, if at such points in time, out of temporary panic, we end up stopping our SIPs, I think that would be a highly unfortunate outcome for investors. So there are two conditions. If you need money, you have no choice but to take money out. Then markets don't matter. Then in a number of units and everything doesn't matter. But if in 2016, 17, 18, 19, when all SIPs which were contracted by us and the investors were for 10, 20, and 30 years long, we have to visualize that what will the environment be in 2030 or in 2025 or 2035 when my goals really come for actual results. And that is when the real value of acquiring units in a cycle like this will come out. So my advice, like always, we always say that SIPs and asset allocation are the two golden principles that really help investors in the long run. People who have done the right asset allocation are realizing the value of that today. And those who continue with their SIPs, acquiring more and more units as markets give that opportunity, will really look through. It is not easy. All that I'm saying is very easy to talk from, air-conditioned room and on a television. In the real world, when we see our portfolios dropping in value, turning red, it is not easy. But who said that investing is easy and making returns is easy? If it was easy, FDs would have taken care of it.
Right, that's right. Kalpen, talk to us about what kind of numbers have you poured into? Earnings cuts are coming all through for the market. How have valuations started looking compared to historical averages? Which sections look compelling? How much have they been crunched?
When we look at the last 20-year data, generally we see that in bear markets, valuations bottom out at around 12, 13 multiples on price to earning. And in bull markets, like we saw a few months back, valuations on the other extreme go close to 30 times. Today, we are somewhere around 18 times, assuming on the same earnings as what was anticipated. Obviously, the same earnings are unlikely to play out, because in the course of next 2-3 quarters, it's a bit early. Right now I'm talking to you without, knowledge of what type of data points will come out, because we have gone into this deadlock or lockdown only in the last couple of days. And we don't know how long will this last. But let's assume for a moment that there is a 15-20% correction in earnings or zero earnings for the next couple of quarters. Discount the worst, assume the worst. It still means that markets are somewhere at around 18, 19 or 20 multiples on earnings. That's one way of, measuring the market. But measuring earnings in an up cycle as well as a down cycle is not right, because, long-term earnings are never in extremes. So there's no point in extrapolating earnings. When you look at price to book as a valuation multiple, there again the market ranges from 1.5 times on the low. In 2008 peak cycle, it had gone up to 5.5, 6 times, but that was an aberration. So somewhere around 2.5, 3 times is the middle of the path average. We are significantly lower than that. So valuation tells us that we are becoming cheap. We are not cheapest. We are becoming cheaper. We were expensive for quite some time. We are normalizing, but we have not reached the other extreme. And markets don't end at one point. The pendulum can keep swinging depending on how news flow, data points on either the identification of a new vaccine or how much more are people affected by those type of data points will determine in the near term where does the market really settle down. And that is very difficult to really predict. But like I highlighted, valuations are getting cheaper than what they have been for the last 3-4 years. That is a good starting point, but that's not the end point yet.
Quick last question. Do you think this bear market we have gotten into is 2-3 month old, Jan onwards when coronavirus started spreading, or do you think it's a continuation of the correction we saw 1.5 years back? What are your thoughts there?
See, my thoughts are currently there are 3 things that the market is grappling with. One is the health scare and the likely extension of that or resolution of that. So that is one big dimension to wait for and its outcome. The second dimension that we are going through, Corona is just the trigger. The trigger is triggering the normalization of valuation, which for quite some time have been on the higher side. And a lot of these higher valuations have been justified in the past with the fact that interest rates world over have been low and they are at their all-time lows right now. And the third dimension, which is important to be aware of, is that globally there's a lot of volatility happening across currencies. There's a large book of derivatives which are likely or getting unwound, and there's a huge amount of liquidity chase or rather currency chase happening in global markets. And 20-25% of Indian stocks are owned by foreign investors. So what happens to their liquidity, their currency outlook, and the corona scare in their countries will also determine how they behave. So it's a confluence of these 3 things, and we are somewhere in the middle yet. I don't see there is an end path yet. We'll have to wait and watch. We'll have to see how data points evolve every week rather than form a conclusion. So I would not seek certainty in a time like this because nothing is certain. I would rather go by probabilities and see where are we in the range of probabilities.
Right. All right, Kalpen, we'll let you go.